Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, UK faces a £22 billion fiscal black hole amid zero growth, forcing pro-cyclical tax hikes as the Bank of England battles high inflation. We'll explore how this fiscal straitjacket complicates the Bank of England's inflation fight and raises the risk of a UK recession. Second, White House imposes rare earth price floors against China, sparking a disconnect as Wall Street rallies on blockbuster bank earnings despite trade war risks. Today, we'll take a closer look at this stark disconnect between policy and markets and what it signals for future inflation and corporate profits. Third, Jamie Dimon's cockroach theory jolts Wall Street as auto bankruptcies expose private credit cracks, sending Jefferies and regional bank stocks plunging. We'll analyse why this first major stress test of the private credit market matters now and how it could trigger wider financial contagion. The UK government is facing a £22 billion black hole in its finances. That's the number the Institute for Fiscal Studies project's Chancellor Rachel Reeves will need to find just to meet her own borrowing rules. She's now given her clearest signal yet that tax rises are on the table, stating she is looking at further measures on tax and spending to make sure that the public finances always add up. This is forcing the government into what economists call a pro-cyclical policy, which is a real trap. It's like being forced to tighten your belt right when you're feeling weak and need more energy. Instead of stimulating a struggling economy, the government may have to raise taxes or cut spending, which risks slowing growth even further. As we've touched on before, these tight self-imposed rules, box policy, and in today's weak data only deepens that bind. This comes as the UK economy is showing serious signs of strain. The latest official figures reveal the economy grew by a mere 0.1% in August, but that's not the whole picture. The previous month's data was just revised downward from zero growth to an outright contraction. This helps explain why a headline uptick like this still feels anemic on the ground, a point we've dug into before when looking at the per-person GDP figures, which were the worst in the G7. The engine of the economy, the massive services sector, saw zero growth. To put this into perspective, this sector accounts for roughly 80% of the entire UK economy. When this primary engine stalls, it's a huge warning sign. Now, get this. This stagnation significantly raises the risk of the whole economy slipping into what's called a technical recession, defined as 2 consecutive quarters of negative growth. Analysts are sounding the alarm. The chief economist at KPMG UK says the outlook remains weak, while another expert at Capital Economics sees little reason to think GDP growth will accelerate much from here. This creates a huge conflict for policymakers. The economy is stagnating, but with UK inflation still high at 3.8%, the Bank of England isn't expected to cut interest rates anytime soon. The IMF has urged the BOE to be very cautious about easing policy, so the bar for cuts remains high. Even a positive forecast from the IMF predicting the UK would be the second fastest growing G7 economy this year came with a huge catch. It also predicted the UK would face the highest rate of inflation among those nations for 2 years straight. So you have this forecast of fast growth alongside the highest inflation, which sounds like a contradiction, but it actually points to a deeper, more worrying problem. Research suggests the UK is suffering from more severe supply-side constraints than its peers' issues like post-Brexit trade frictions and labour shortages. The real-world consequence is that this persistent inflation premium could force the Bank of England to keep interest rates higher for longer, threatening UK assets and the British pound. And as we've discussed, global economic fragmentation like ongoing US-China trade frictions could sap demand in key UK export markets, amplifying these domestic constraints. Looking ahead, the upcoming budget will be critical. Investors will be watching to see if the government sticks to its strict fiscal rules. At the same time, all eyes are on the next inflation report, especially the services inflation number, as it will be a key signal for the Bank of England's next move on interest rates. Speaking of those US-China trade frictions, the White House is now taking a dramatic new step that's sending ripples through the global economy. It's drawing a new line in the sand with China, announcing it will directly intervene in the market by setting price floors for rare earths. So what does a price floor actually do? It's essentially a government-guaranteed minimum price. This is a tactic the US has used before. Think of agricultural price supports that have been used for decades to stabilize farmers' incomes. The goal here is to protect and encourage America's own domestic production of these materials, which are vital for everything from EVs to advanced defense systems. However, this policy comes with significant risks. US manufacturers will likely have to pay higher prices, squeezing their profits. More importantly, it's a direct challenge to China that could easily provoke retaliation. In a stunningly bold statement, the Treasury Secretary said not even a stock market decline would change America's stance. Interestingly enough, while Washington prepares for this economic battle, Wall Street seems to be completely shrugging it off. Major US banks like Bank of America and Morgan Stanley just reported blockbuster earnings that shot past expectations, turbocharged by a hot M&A market. However, if you zoom out, you'll see another layer to this story. A big chunk of this profit isn't actually coming from the bank's core business of lending. That's measured by net interest income, or NII, which for some banks has been under pressure. The blockbuster numbers are instead being driven by volatile investment banking fees. If the trade conflict spooks companies and slows deal making, this pillar of market strength could crumble. This situation presents a fascinating duality. On one side, the government is digging in for a trade war, while on the other, Wall Street is celebrating as if the party will never end. Traders are pushing equities higher, with the Russell 2000 hitting a fresh record. And that's not all. The Federal Reserve's own beige book confirms that tariffs are already pushing prices higher on the ground, with some companies now fully passing those increased costs to customers. The degree to which they do this, known as tariff pass-through, creates a huge dilemma. If companies pass the costs on, it fuels inflation. If they don't, it crushes their profit margins. The beige book shows both are already happening. This sets the stage for a massive collision. The market's record-setting optimism is now directly at odds with hardline industrial policy and the reality of rising costs. The upcoming earnings from tech giants like Tesla and Intel will be the real test, revealing whether Wall Street's rally can withstand the real-world fallout of this escalating conflict. While Wall Street has been shrugging off those geopolitical risks, a different kind of fear is starting to take hold, sparked by a chilling warning from one of banking's biggest names. JP Morgan CEO Jamie Dimon just dropped this quote: "When you see one cockroach, there are probably more." And right now, investors are furiously looking for those cockroaches. In finance, this is what's known as the cockroach theory. It suggests that when a company reveals one piece of bad news, it's rarely an isolated incident. More problems are likely hiding in the shadows. This fear can trigger a credit crunch, raising recession risks. What really brought this to a head were the bankruptcies of two auto industry related companies. The auto sector often acts as a canary in the coal mine for the broader economy, so these bankruptcies are early warnings of stress among consumers being squeezed by high financing costs. Shares of investment bank Jefferies plunged more than 10% after it was revealed that hedge funds it runs are owed a staggering $715 million from one of those bankruptcies. UBS also confirmed it has about $500 million in exposure, but the fear is spreading. The SPDR S&P Regional Banking ETF plummeted over 6%. So the thing is, these regional banks are in a particularly tough spot, still fragile from the 2023 interest rate crisis. They now face a second wave of pressure from deteriorating credit quality. Zions Bank Corporation cratered after admitting a sizable charge from bad loans, and Western Alliance dropped after alleging fraud by a borrower. This is an industry where investors, as one analyst wrote, tend to sell first and ask questions later. The core of the anxiety is the opaque private credit market. To really get what's happening, you have to understand this private credit market. It's essentially a multi-trillion-dollar shadow banking system of lending by non-bank institutions like private equity firms and hedge funds. And believe it or not, according to the Financial Stability Board, this non-bank sector's assets now make up nearly half of the entire global financial system. The true scale of risk within this opaque market is unknown, and these bankruptcies are its first major stress test. The immediate concern now, of course, is contagion. Stress in the US private credit market could trigger a flight to safety among international investors. This could cause a sharp repricing of risk globally, leading to capital outflows from other markets and a stronger US dollar, which tightens financial conditions for everyone. The key indicators to watch going forward will be credit spreads on high-yield bonds and data on international capital flows. These will give us the first signs of whether this cockroach has friends. This content is for informational purposes only and is not investment advice. All financial data is subject to market volatility.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.